Welcome back to the personal finance course and this video on life insurance. This is the second video. We talked in the first video about what an insurance policy is. It's a contract between an owner of a policy and an insurance company or carrier. The owner pays a premium. The carrier guarantees to pay a death benefit upon the death of the insured. The beneficiary receives the payment, the death benefit claim. Those are the three parties to the insurance contract: the owner, the insured, the beneficiary. We talked about how death is a hugely impactful life event and how insurance is a very important part of planning. How do you decide if you need insurance? If you have responsibility for someone else, if someone is going to have responsibility for your financial commitments if you pass. So we're now talking about another aspect of life insurance. Sometimes people will say to me, well, if I didn't die, I wasted my money on life insurance. And that's not true. Another way to think of this is like an option. Life insurance is like paying a premium. It is paying a premium, but it's like buying an option, meaning that you're paying for the right to have someone give you a benefit should something happen. It's more expensive than not paying for it, but the impact of a loss is incredible. I've used this example in my courses often, but there was a student a number of years ago who purchased insurance for her computer, and when her computer blew up before midterm, she was terrified that she wouldn't get her work done. She bought a new computer and bought the insurance as part of it. Another student said, well, that insurance on the computer is a waste. And I didn't know exactly how to respond. A few weeks later, I went back to the student in the classroom and we talked about it. And I said, how impactful is it to lose your computer before midterms? She said, incredibly. It's a catastrophe. I said, how much did the insurance cost? And I think she said $100. I said, well, is that a lot for you? She said, well, it's a lot. I'd rather not spend it, but I can afford it relative to the catastrophe of losing my computer. That's the point about life insurance, and the point about thinking of it as an option. You pay a premium, pay an amount that is more than paying nothing, but the impact of a loss, a death, is catastrophic. And so having this small amount paid toward the benefit of a larger amount should you have a catastrophic loss is worth it. It's a very important part of financial planning when responsibility exists. Now, how much face amount do we need? How much death benefit do we need? There are lots of rules of thumb for quick assessment. If multiples of income, what's your status in life? Do you have kids, no kids? But I think if you ask the question, how do I want my survivors to live if I pass prematurely? If the answer to that is I want them to live the way they do now, I recommend a simple arithmetic approach. First of all, calculate a total amount of debts outstanding: mortgage, line of credit, credit cards, auto loans. Look at future obligations to fund for children, for example, like college for minor children. You want to also have enough principal to provide income that replaces the income of the past spouse. And then burial costs. Add those together, excuse me, and you have an amount of life insurance that you need. Again, pay off family debts, college for minor children, enough principal so that you can generate income to afford the lifestyle that you currently have, and then burial costs. For a younger person, a college student, for example, you might only have debts like auto loan or maybe school loans, which may be forgiven. I don't know in the case of a death. As you get older, maybe you have a mortgage or those sorts of things. There are two types of life insurance: term and permanent. Term insurance provides death benefit only. If you think of the cost of insurance like this, when you're younger it's less expensive, and when you're older it's more expensive. It literally goes like this. And term insurance is the least cost relative to the benefit. It's most commonly purchased in 10, 20, and 30-year level premium structures because that's what the market wants. There are also annual renewable structures, meaning it goes up every year, and it's lower cost in the first few years, but more cost by the third or the fourth year. And it's designed that way so that the insurance industry has fewer products to sell and can therefore lump more of their business into fewer products. 10, 20, and 30-year level premium structures are the most common these days, and that's what clients ask for. And permanent. If you consider the cost of insurance being like this, as you age, if you pay a premium that's greater than the cost of insurance, up here, remember for term it would be like along here, for permanent it would be up here. That cash that's paid in excess of the cost of insurance accumulates tax deferred in the policy. Insurance has a tax deferred accumulation preference, much like 401k plans. It's not a 401k plan, but it's like it in that respect. So it's a very good use for future savings, for executive benefits, and also good for if you need insurance for the whole of your life. So it's designed to own insurance for the whole of your life. Remember, with term, you're generally going to only own it for 10 years and then get new, 20 years and then get new, 30 years and then get new. Permanent is designed to last the whole of your life. There are various types. Whole life is the most common. Certainly the most common through the 70s when it was superseded, or when universal life was introduced. Universal life incorporated one feature that was new, which was the flexible payment of premiums. In the 80s, variable universal life was introduced. It was at the time when mutual fund supermarkets were becoming popular, 401k plans were becoming popular, and people began to select their own and wanted to select their own investments. And indexed and guarantees, indexed universal life and guaranteed products have come later, and they were reactions, for example, to wanting to get some market return but not lose account value if the market return went below, say, zero. Guarantees for that same purpose came after the tech bust in 2001, and so, but the oldest product design, whole life, introduced in the 1970s, universal life with flexible premium payments, variable universal life where you make the selections of investments, and universal life, the insurance company makes the selections. With variable universal life, you make the selections with the help of your advisor, for example. And then there are newer designs like indexed and guaranteed products that came later. Owner design, individual, it's one person, and survivor or joint life for two people. If you think about it, two people insured might be a husband and wife, or two spouses, husband and husband, wife and wife, same-sex marriages. Could be business partners. There has to be an insurable interest between the two people. But actuarially, when there are two insureds, one is going to live. The expectation is one will live longer. Statistically, it shows that's true. So if one person might live to age 80, between two insureds, one might live to 90. And so joint survivor insurance is often less expensive, maybe as much as 25% less expensive. So in cases where it's useful, joint is worth considering. Individual is the most common purchase. Most people buy individual. It insures one person. It's useful for spouses, families, businesses. Group insurance is available through your employer. Group insurance usually doesn't require underwriting. It's not available in as large an amount as individual would. With individual insurance, the insurance carrier knows more about you. It gets access to your medical records, does a medical exam, asks more detailed questions. Where with group insurance, it's offered as part of your employment. You can select it up to a certain amount. It is good if you have underwriting issues, medical issues that would make individual insurance prohibitively expensive. And so you should always look, and particularly in a married couple, should look for both spouses to see if they can get insurance through their employer. It's not on a case-by-case basis less expensive, because when an insurance company has more information, it can provide the insurance less expensively to you. But it is convenient and it is cost-effective. And again, if you have medical issues, it can be a very important way to get insurance. Two types of company designs, mutual and stock companies. Mutual used to be what most companies were. It was very common. Less common today. In mutual companies, the company is owned by the policyholders. It's more common with mutual companies that the agents that distribute their products are captive, meaning they work for the company. The better known mutual companies like Northwestern Mutual, New York Life, Mass Mutual are highly rated, AAA rated. And some would say that part of that high rating comes not only from their financial strength, but also from the fact that they control their distribution. They can get their salespeople to sell the products they make. And not surprisingly, some of the products, the carriers that make whole life insurance, which is a robust, profitable product, are made and distributed by mutual companies. Stock companies, by comparison, are owned by shareholders. Their agents are more commonly independent. I like to think of it that stock companies have to design products that people pick. And if people choose them, they have to be competitive. And I'm not saying that mutual company products are not competitive. They have to be competitive too. But it's less common to see whole life insurance offered through stock companies, and more common that their distribution are independent, representing a wide variety of companies. Insurance companies are rated by Standard & Poor's, Fitch, and Moody's. May be rated by other companies too, but they are the three largest primary rating agencies. All things being equal, higher ratings are better. AAA is better than AA. AA is better than single. There are times when a single A company will provide better underwriting, less expensive product choice, and that might be worth it, and you just have to weigh it. All things being equal, excuse me, higher ratings are better. Interesting to know, though, that AAA rated carriers have gone bankrupt, like Mutual Benefit, Executive Life. Insurance companies have never not paid a death claim, so even if they go bankrupt, their industry protection enabled death claims to still be paid. Sometimes people have had a challenge getting their cash value out of products when their company has gone bankrupt. There have been many, but some of those, though, some of the well-known ones, Executive Life and Mutual Benefit I mentioned, were AAA rated. And so that's a contradiction. All things being equal, though, choose a carrier that's higher rated. And you should know if your agent is working for an insurance company as a captive or if they're independent. Captive advisors can certainly be trustworthy and give you good advice, but it's just important to know where their economic interest, and make sure that they're guiding you and not pushing you to select something that's offered by their company. Life insurance advisors can be captives. We've talked about them. They work for the company they represent. They can be independent, in which case they represent lots of different companies. They could be financial planners, financial institutions, meaning banks or brokerage firms, accountants, attorneys, and these advisors are always required to be licensed by their states and have national licensing if they offer securities-based products. And last for this section, life insurance industry is regulated state by state. Theoretically, that's safer. I don't know if that's a historical issue or if that's meant to provide more protection to consumers. It's cumbersome, meaning that when products are introduced, they have to be approved state by state by state. Some states are quick. Some states, California and New York, surprise, are slower. Sometimes some companies don't even offer products in those states because of the slow approval process. And then you should also know that the money in permanent life policies are managed in what are called general accounts. That's when the insurance company manages it. And in separate accounts, that's when an investment firm manages it. You make the selections or with your advisor, but they're called separate accounts. They're managed by a third party. If it's managed by the insurance company, it's called on the general account of the insurance company. All right, this is the end of life insurance section 2. Stay tuned for the final section 3.